There's a secret clock ticking in the background of every crypto rally you've ever witnessed. Most traders never see it. Most influencers never mention it. But the institutions, they set their watches to it. And today, you're going to learn to read time the way they do. This is for education only, not financial advice. Crypto moves fast, and you should always manage your own risk. Now, let me ask you something. Have you ever noticed Bitcoin pumping 3 months after the Fed starts easing, or crashing months after they tighten? That's not coincidence. That's the lag. Let's dive in. Number one, the fundamental truth about liquidity. Money doesn't teleport into Bitcoin the moment it's created. When central banks expand their balance sheets or when global M2 money supply increases, that liquidity needs time to work its way through the financial system. First, it hits banks, then it flows into bonds, then equities, and finally it reaches the risk on frontier where crypto lives. Research shows this process takes approximately 60 days. Some studies show it's closer to 8 to 12 weeks, but the pattern is consistent across every cycle. Bitcoin doesn't react to liquidity today, it reacts to liquidity from 2 to 3 months ago. Number two, the hard evidence. In 2020, where the Fed expanded its balance sheet by nearly $5 trillion, Bitcoin didn't immediately rocket. There was a lag. The Fed's balance sheet peaked in April 2021, but Bitcoin hit its all-time high in November 2021, roughly 6 to 7 months later, when quantitative tightening began in early 2022 and reverse repo exploded to $2.4 trillion. Bitcoin didn't crash immediately. It took months for the liquidity drain to fully impact price. The correlation between global M2 money supply and Bitcoin exceeds 84% across most time frames when you account for the lag. Without the lag, the correlation looks random. This lag is the difference between confusion and clarity. Number three, why the lag exists. Think about how money actually moves through the system. Where the Fed expands its balance sheet, that money first goes to primary dealers, the big banks. Those banks then led to hedge funds and institutions. Those institutions allocate to various asset classes based on their mandates and risk assessments. Crypto sits at the far end of this chain. It's the highest risk, highest volatility asset class, so institutions allocate to it last, not first. By the time fresh liquidity finally reaches crypto, 60 to 110 days have passed. Different studies show slightly different optimal lag periods. but they all cluster around 2 to 4 months. This isn't a bug, it's a feature of how capital flows through the global financial system. Number 4, how to use this edge. Here's the game changer. You can see Bitcoin's future by watching macro indicators today. When global liquidity starts expanding, you don't need to wait for Bitcoin to pump. You already know what's coming in 8 to 12 weeks. When central bank balance sheets start contracting, you don't need to wait for the crash. You can position yourself defensively 2 to 3 months ahead of the move. This is what institutions mean when they talk about positioning ahead of the curve. They're not predicting, they're just reading the clock. Number 5, the rate of change matters more than the level. Here's something critical most people miss. It's not just about whether liquidity is high or low. It's about whether it's accelerating or decelerating. Bitcoin's strongest bull runs occur during periods of rapid liquidity expansion, not just high absolute liquidity levels. In early 2021, global M2 was already elevated, but it was the acceleration in the rate that sent Bitcoin parabolic. In 2023, M2 actually contracted for the first time in decades. Bitcoin struggled. Then, when M2 bottomed and started turning upward again, Bitcoin found its cycle bottom within 3 to 6 months and began rallying. Always watch the change, not just the snapshot. Number 6, the current setup. So, where are we right now? Global liquidity has been stabilizing at cycle lows. Central banks have started cutting rates. The Fed has pivoted from quantitative tightening toward a more accommodative stance. Reverse repo has drained over 90% from its peak. These are all liquidity positive developments, but remember the lag. These improvements in macro conditions today won't fully show up in Bitcoin's price until 2 to 4 months from now. If you wait until Bitcoin is already pumping to recognize the macro tailwind, you're already late. The edge is in seeing the setup before the move begins. Number 7, the mistakes everyone makes. Here's what I see constantly. People watch macro conditions improve, then panic sell 2 weeks later when Bitcoin drops 10%. They forget about the lag. Macro tells you the direction over the next quarter, not the next week. Short term volatility will always exist. Liquidations happen, news events cause spikes, but if global liquidity is expanding and you understand the 60 to 110-day lag, you know that 3 months from now the probabilities favor higher prices. Don't confuse short-term noise with long-term signal. Number 8, how to track the lag yourself. You don't need to memorize complicated formulas. Just follow this simple process. Check global M2 liquidity trends every month. Is it expanding or contracting? Is the rate of change accelerating? Check central bank balance sheets, especially the Fed. Are they expanding or contracting? Look at the H.4.1 report every Thursday. Check reverse repo levels. Is money coming back into the system or being pulled out? Then mentally shift everything forward by 60 to 90 days. That's your Bitcoin roadmap. Number 9, the compounding advantage. When you understand the lag, you're not just one step ahead, you're an entire cycle ahead. While retail traders are reacting to price action today, you're positioning from price action 3 months from now. While panic sellers are dumping on red candles, you're calmly accumulating because you already know what the liquidity data says about the next quarter. This is how you go from trader to strategist. Final word: macro moves first, crypto moves later. Every single time. The lag isn't a theory, it's a documented pattern with over 8% correlation when properly measured. Most people will never learn this. They'll keep chasing pumps and panic selling dips, never understanding that the game was decided months ago. But you're not most people anymore. Now here's what I need from you. If this clicked for you, if you finally understand why timing matters more than most people realize, drop a comment and let me know what's your biggest takeaway from understanding the lag. And if you want to stay ahead of the curve while everyone else is still reacting to yesterday's news, hit the subscribe button. I track these macro signals every single week and break them down so you can position yourself months before the crowd even notices. See you in the next one.